on asset quality, bad news is coming through thick and fast. The market is saying a China +1 to purana story hai, nahi hoga. I'm not so sure. I think a lot of what America is doing is reasonably easy to see. A lot of this is posturing, and I'm taking the posturing with a large pinch of salt, maybe even half a spoon of salt.
What gives you the confidence that we will have a more favorable deal compared to China?
The thing about the current administration in America is they're reasonably transparent about being, about taking a negotiating position on everything.
Now, to go back to the point that you were making on private sector banks.
So if you're downhill racing, then a 1 liter engine ka gaadi and a Ferrari, he's driving a Ferrari 4 times price to book. Mein hamari 1 liter 1 times price to book ki bank bhi utni bhag rahi hai, right? And they were right.
How do you think your approach to valuations has really changed?
The hardest learning of them all, right, was Relaxo.
Was it stressful? What are some of the personal lessons you've taken away?
And it's a bewildering experience. Then the biggest challenge is early success blindsides you.
This is a cycle that every investor goes through at some point in time or the other.
You read about it to reduce the mistakes.
Hello and welcome to the Wealth Formula. Today, my guest is somebody who is a very familiar face in Indian markets. He's somebody who's made investing intelligible for a lot of investors through very clearly articulating his investment thought process through multiple videos, interviews, and many, many books that he's written. Saurabh Mukherjea, founder of Marcellus Investment Managers. Saurabh, as you know, is to do with, your investment style, your experiences, your evolution as an investor and so on. But then we will first do a few questions around the here and now that is important to investors. GST redesign, what do you think? Will this create conditions to stoke consumption demand?
So Mahalakshmi, for several quarters now, we've been highlighting that the combination of a weak jobs environment, weak wage growth, and alongside that, very household debt, right? Using the RBI data, my calculation suggests that household debt as a percentage of income has reached record levels in India, and the impact on NPAs is now evident. All of that had meant that for several quarters now, consumption is struggling. Consumer-facing companies, many of them in our portfolios, have been struggling. So absolutely delighted in that context to hear the Prime Minister's 15th August announcements. Couldn't have been better timed. We're looking forward to the GST rationalization. I think the market has already figured out that sectors like auto will do reasonably well out of it. Will it be enough to turn around the tide on consumption? I'm not so sure. I'm not so sure of that just yet. I think there will be more required. So just to sort of quickly rewind on this, the RBI has cut rates by 1% or so. So I think kudos to Governor Malhotra. I think there's more required there, right? Inflation is subdued. And whilst I appreciate that the Monetary Policy Committee members are guarded in their comments, I'll be absolutely astonished if over the next 12 months, we don't get multiple rate cuts, right? Second thing is the Finance Minister in her budget gave that income tax break all the way up to 12 lakhs, no income tax. I think much required. This GST cut, much required. But I think we'll need another stimulus for consumption in the budget, because otherwise the debt burden is so high and the job scenario is so tough, so bleak, that it's not going to be easy just to turn around consumption on the back of this relief. So I think there'll be multiple sets of stimuli required to juice up consumption, but this GST cut was much required, step in the right direction, and a lot of credit to the government for expediting this.
So in terms of, stock market, the various quarters in the stock market, is this enough for you to start betting on consumer stocks? What makes you relatively bullish?
So look, given our house style, there is not that much else that we were investing in, right? It's very difficult given the Marcellus house style, the style that you're referencing, the coffee can investing style that I wrote about in the book back in 2018. It's very difficult for us to invest in PSUs or companies that have wildly volatile revenues, or indeed these new economy companies who struggle to make any money, right? So implicitly, therefore, we are loaded up on consumption, healthcare, financial services. I think those three sectors will roughly be 80% of our portfolios, right? And naturally, therefore, we've got a nice fillip this month on the back of the 15th August announcement. Our portfolios are doing relatively well. We'll stay the course on this, right? My reading is, given that we are a democracy, and given that the ordinary Joe out there determines the fate of our politicians, I think the polity will expedite a consumption revival over the next couple of years. I don't think it will come in the next couple of quarters. Some people believe it will happen fatafat. I think it will take a couple of years, but I think the polity will expedite that, and I'm confident that our portfolios will benefit from that. Given the orientation around healthcare, financial services, and consumption, we should be doing quite nicely out of both the rate cuts and the tax cuts, which I think will come through over the next year or so.
Okay. So if you were to break down this, you're saying 80% of your, your portfolio money in the large funds is invested in consumer healthcare kind of businesses. Can you break that entire segment down for us in terms of where do you see even now opportunities and where do you see maximum pain, which is unlikely to look up at least in the next 1 year?
So let's start with the straightforward opportunities, right? We're in the midst of a massive realignment in healthcare in our country. The government is pulling back, and the government is saying there is the Ayushman Bharat will take care of those who are needy, and it's I think well constructed insurance scheme. It's also effective, right? A lot of people in cities say Ayushman Bharat se kya fayda. I've traveled to plenty of places in India where I can see Ayushman Bharat is turning out to be transformative in terms of healthcare for the poor. As that happens, hospitals, diagnostics, pharmaceuticals will carry on getting a boost, right? Effectively, the private sector will be required to put up way more hospitals than currently exist. Diagnostic services will be required on a far greater scale than currently exist. And the pharma industry will also benefit. You could argue that the volume growth will be far greater than the profit growth because you're trying to build, the private sector will have to cater to the masses rather than just the elite in South Bombay and South Delhi. But I think there's money to be made there. We're already invested in hospitals and diagnostics. We're thinking of making more investments in that space. So that's the first area, right? Plenty of headroom there. Structural story, the country will spend on it, and the government is saying we are throttling off. Private sector, you step up. Second is high quality lenders, right? So through COVID, or the first part of COVID, high quality lenders, companies that we've been long-standing investors, Bajaj Finance, HDFC Bank did well. But then in the post-COVID revenge spending wala recovery, aided, abetted also by government capex, usme the high quality lenders fell back, right? And we rightly, I think, got a lot of stick for that. But now that the economic circumstances have once again, over the last 4 quarters, the economic tide has turned, right? It is now evident why an HDFC Bank will do far better than almost any other PSU, barring SBI. My reading of the situation, Mahalakshmi, is we're heading back to a situation where effectively 3 banks will do well, and the rest of the banks, I think, will have a really, really tough time on both sides of the balance sheet. I think HDFC Bank, ICICI and SBI seem to be well placed on both sides of the balance sheet. Of those, we have a large position in HDFC Bank, we have a smaller position in ICICI, but I think the PSUs are going to have a really rough time as the asset quality piece deteriorates. On asset quality, bad news is coming through thick and fast. Leaving aside the results, when I travel around the country, it's evident that there is deep-seated distress, not just in MFI and unsecured, but middle class India ka debt position is pretty weak, and the RBI Financial Stability Review actually gives a pretty graphic picture of that. So quality lenders, I think we'll revert to what we saw in 2015, 16, 17, 18, where a handful of quality lenders ended up getting re-rated, and the run-of-the-mill lenders went to 1 times price to book. So that's the second area of opportunity I see. Folks, in this I'll just stress to your viewers that I'm invested in all of this through our portfolios, so are my parents and obviously our clients, right? The third area that we think there could be opportunity is, at this juncture, because of everything Trump is doing, the market is saying ye China +1 to purana story hai, nahi hoga. I'm not so sure. I think a lot of what America is doing has been, and it's reasonably easy to see, a lot of this is posturing, and I'm taking the posturing with a large pinch of salt, maybe even half a spoon of salt. My reading is India will get a reasonable tariff deal. Europe is on a 15% tariff with America, so I don't think we'll be getting 15, but I think 20-25% type tariff deal hoga. And in that context, given that the likelihood is China will end up with a 30% tariff wala deal, I think China +1 opportunity will be there. Specialty chemicals, active pharmaceutical ingredients, auto ancillaries. There will be an opportunity there, and at the moment the market is becoming pessimistic about that. But I think for those who are willing to take a rational point of view on the subject rather than being spooked by Peter Navarro's brutal columns in the FT, if you're willing to take a rational point of view, I think there's money to be made on the China Plus One opportunity as well.
What gives you the confidence that we will have a more favorable deal compared to China?
So the good thing about the current administration in America is they're reasonably transparent about being about taking a negotiating position on everything, right? So they're very clear that look, if Putin does a deal on Ukraine, and America is pushing hard for that deal. If Putin does a deal on Ukraine, then we will stop pressurizing India to pressurize Russia. Okay? So if Putin doesn't do a deal, then they'll keep ratcheting the pressure. So to the extent that at some stage the Russian president will cut a deal with Europe and America on Ukraine, I think once that happens, we'll see rationality prevail, and a 50% on which last night Peter Navarro threatened further on the 50%, right? He said or dalenge, right? So when they say these sorts of things, right, I chuckle because it seems so mad that you have to say one day sanity will prevail. So I'm being an realist here. I don't think I'm being an optimist. I think I'm being a realist here. I'm being realistic here that Europe is on 15, China is on 30. We'll end up somewhere in the middle, which still gives room for China Plus One, because to make API in America, if you want to make the Dawai, Divi's lab makes the API, Divi's lab makes, it'll cost you 8x as much. Why will the American government force pharma companies to pay 8x as much to make active pharmaceutical ingredients, which also have environmental consequences for your country? And similarly on auto components, because if America doesn't give India a 20-25 wala deal, then they'll become even more dependent on China, right? Which I presume is something that they want to avoid, given everything we've heard from this administration over the last 7, even in the previous, in Trump 1 wala administration. So China Plus One, where we remain invested. We have large position, for example, in Divi's lab. We've had it for many years. We increased it after the stock halved post-COVID. And we remain optimistic that rationality will prevail in the American point of view. Remember, anyway, pharma is exempted from it, plus electronics is exempted so far, right? And therefore, if pharma is exempted, electronics is exempted, वहाँ पे तो आप China Plus One view अभी भी ले सकते हो, right? What you're worried about is the auto wala piece. But I think, again, if America wants to reduce dependence on China, then they need to give India a reasonable deal on auto as well.
Okay. Now, to go back to the point that you were making on private sector banks, you said that, while you're traveling, you sort of found that the distress in retail is visible. Tell me more about it.
Let's first start with the results, right? Results Q4 last year and Q1 this year. You can see that MFI is still struggling, right?
Correct.
Every quarter, some new state impositions, some new impositions, some new state creates a rule saying आप पैसा collect करोगे तो वो criminal offense हो जाएगा. Very difficult to run a business if collecting money is a criminal offense. Then the credit.
So what does that mean? So you're saying they are loosening the stance on collection, or what?
The states are making it harder for MFI lenders to go and collect money. Right. Every state says, "नहीं boss, legitimate collection तो मैं discourage नहीं कर रहा." But try being an MFI lender who has to go and explain in a village in Karnataka or Bihar that what I'm doing is legitimate. What the state government announced is something else. It's hard, right? And therefore NPA numbers, I think, will remain a challenge at the grassroots level. Thankfully, there are no elections around the corner, right? Barring Bihar, stress is showing up. SBI cards numbers are evident, are available for everybody to see. In Q1 results, you could also see used CV financing में the stress showing up in used CV financing. Generally, logistics industry is a industry linked to the economy. If economic activity is subdued, naturally logistics struggles and CVs struggle. Interestingly, in the 1Q results, I was surprised to see even in mortgage finance, the first signs of stress show up, right? And I was very surprised to see that. I thought mortgage finance mein stress ek saal baad aayega,
right?
But you can already see mortgage finance mein stress build up. So we did some inquiries on that, and what we are hearing from the DSAs, right, the direct sales agents who originate loans for banks and NBFCs, they are saying first check bounces are at 10-year highs. And interestingly, Mahalakshmi, they're saying first check bounces are in 10-year highs in the big tech centers, jaisa ki Bangalore, Hyderabad. So when I asked them, they said what happened was in Bangalore, places like Bangalore, Hyderabad, during COVID, a lot of the double income tech families, they bought larger flats because both partners were working from home.
Right.
And now that the job situation has turned adverse in tech, those families are finding it hard to keep up with both personal loan repayments and with mortgage finance repayments, right? So this is going to be a very interesting space to watch. If the tech job losses continue, and my readings also financial services may be ho raha hai. The financial services players are being a little bit more reticent to make that public. But if you look at the annual reports of the big banks, the big NBFCs, you can see that
Count is going down.
So you can see that they're opening thousands of branches, but headcount niche ja raha hai. So this jobs piece and the interplay of that with secured lending will be interesting to watch. The RBI's financial stability reviews continue to flag challenges here. My reading of the December 2024 wala financial stability, my reading of that was roughly 1 in 10 middle class households has taken on home loan, vehicle finance loan, multiple credit cards, multiple personal loans. And when I did the maths basis the financial stability review ka data, my reading was 1 in 10 middle class households will not be able to repay their loan, right? Because the weighted average interest rate on that is well ahead of whatever their wage growth is. So usko debt trap bolte hain. And I haven't seen this situation before in India, but this is I think this is a tricky situation. And my reading is SBI, HDFC, ICICI. These banks seem to be holding their own on asset quality. Barring that, pretty much everybody else is now on a very sticky wicket.
A typical Bangalore, household, from which bank are they more likely to take a mortgage finance? It would be one of these three banks. So how is it that stress in that section cannot reflect in terms of NPS in these
banks? So I think that's the clever part in lending, right? So what makes one of the reasons we've stayed invested in HDFC Bank through thick and thin is exactly this point of view. A lesser lender will use heuristics such as, this is a tech worker from Bangalore, isko to home loan de do, bada loan de do, because he's a tech worker from Bangalore. And HDFC Bank has, I think, far cleverer underwriting, and therefore they're able to do that second, third layer. Yes, he's a tech worker, but tech jobs are not forever. And given his income and her income, given the family income, these guys are leveraging themselves up to a point where we are uncomfortable, and therefore let's encourage them to balance transfer out. And that's what a clever lender does. A clever lender will keep assessing risk in the existing book and saying if the risk build-up looks nasty, nudge the interest rate up. And I've seen this with Bajaj Finance across many cycles. I've seen this with HDFC Bank. If this cohort is looking risky, make sure that the interest rate becomes reflects the risk in effect. And if that leads to the customer balance transferring out, then so be it. Right? It's a tough skill, and it's a skill which requires both leadership, because you're encouraging riskier customers to refinance out, and it also requires obviously top class risk assessment systems. I'm not so sure beyond HDFC Bank and ICICI Bank how many other banks are on top of their game on this aspect, right? Both the risk, the metrics aspect, and then the credit quality management aspect.
But tell me more about it. For example, this job situation in tech has become clear only in the last few months. I'm not sure 1 year back or 2 years back if, anybody was aware that AI is going to become such a big threat, or companies will not hire for whatever reasons, right? So if you are on a loan, for you to change the terms of the loan, even, I'm presuming most of the loans now are only on, floating rate. So you rejig according to whatever is the prevailing lending rate. You can't really change the terms, right? Like, how do you dissuade an investor and a high risk borrower to actually get out of the loan, to get that risk out of your book? Is that even possible?
So I think three levers that I've seen used, right? First is when an existing customer says, I want to take buy an even bigger house, take an even bigger mortgage, right? At that juncture, the lender has to make a tough call on, given his or her finances, should I be overextending myself? So at that point, there's a clear risk repricing. A lesser lender will say, "Arey, this is good. This is a good customer. Default nahi kiya hai." Rather than a 2 crore ka loan, he wants a 4 crore ka home loan. Let's roll out the red carpet. A smarter lender will be circumspect on that repricing. Right? This is the first trigger. The second trigger is when the RBI cuts rates and all other banks drop their rate. Do you drop proportionately, or do you drop at different speeds for different risk cohorts, right? And a smarter lender will say, "ठीक है, RBI has cut rates by 100 bips. I don't have to pass on that 100 bips to every constituency in my customer base. The riskier constituencies, I'll keep them a little higher. And if that means they BT out, balance transfer out, then so be it. I'll live with that." And the third piece is on the new origination, right? Leaving aside the back book, on the new origination, if you're seeing Bangalore real estate is on fire, prices are going up, and households are leveraging up constantly with prices going up. You need a firm hand at the tail, at the top, right? The boss has to make a call. Kitna humko bhagna hai with the rise in, with the bubbling up of real estate, right? And I would submit to you that the men and the boys, the women and the girls separate at exactly this juncture of the cycle, right? So what happened in the first 2 years after COVID, so December 21 say, sort of COVID, assume December 21 was roughly the end of COVID, till December 23 it was like downhill racing. So if you're downhill racing, then a 1 liter engine ka gaadi and a Ferrari look the same. And a lot of people laughed at me saying, "Look at this moron. He's driving a Ferrari 4 times price to book में हमारी 1 liter 1 times price to book की बैंक भी उतनी भाग रही है," right? And they were right. And for 3 years we made no money on good lenders, right? And I sat there and we took the flak. And those who criticized us were right to do so. There's a learning for us there as well, that if the economy is going gangbusters, right? COVID का revenge spending चल रहा है, government is growing capex at 30%, then what's the point of having a quality portfolio? Because lesser quality companies are also growing earnings at much the same rate, right? But then when the party ends, and Diwali 23, roughly, the party ended, and it's an uphill slope now, the going is tough, the Ferrari pulls ahead of the 1 liter engine ka gaadi, right? Now, some people will say, well, we will buy the Ferrari when the slope is upward sloping. When it's a downhill race, we will have a 1 liter engine. Those who can time the market like that, good for them. We unfortunately don't have that skill, right? We don't quite have that skill to say, economy is now soft, we will be buying HDFC Bank. Economy is now roaring, hot, now we will sell HDFC Bank and buy a 1 times price to book lender with loose underwriting quality. And hence we suffered that underperformance. And then as the economy has slowed down in the last year and a bit, our portfolio performance has returned. And thank God for that.
You are still betting on Bajaj Finance, ICICI Bank.
So Bajaj Finance, the position, we reduced it dramatically as we sensed the cycle turning actually 6 quarters ago. Right, I remember doing lots of calls with my colleagues, traveling around Tamil Nadu, Karnataka, calling the office saying, यहाँ पे गया हूँ, कोयम्बटूर में गया हूँ, Bangalore में हूँ, Hyderabad में हूँ, doing calls with my colleagues back in the office saying clear signs of the asset quality cycle turning, and we throttled off on the Bajaj Finance position, and in some of our portfolios we moved the position from finance to FinServ, right? तो वो छोटा कर दिया हमने, which means that some of the rally in Bajaj Finance we actually haven't got the full benefit from it. But the HDFC Bank position stayed big, and we benefited from it. And in our lending, in our Kings of Capital portfolio, we also had ICICI Bank.
Tell me, over the last 3 years, how do you think your approach to valuations and this whole idea of moat investing?
Heavy duty forensics. Try very hard using quantitative and qualitative research to avoid the rogues in the market. In any stock market, you will have 30 to 40% of companies who are flattering their numbers to impress the stock market, juice up the share price, issue some fresh shares, do a QIP, etc. So avoid करना है, पहले भी था, अभी भी है. The second piece is amongst the cleaner companies, focus on those with stronger franchises. Just to keep it simple, measure a franchise using say ROCE and return on capital above cost of capital over long periods of time being a basic measure of franchise quality, right? What we learned in the 2022-23 pullback, right? We learned three things. Firstly, if by definition a steady eddy franchise, a consistent compounder, right? Consistent compounder का underlying profit compounding आपका 15 maybe 20% in good years, but 15% के आसपास होता है. If the share price doubles in 12 months, 18 months, there's a high chance that there will be a reversion to mean on the share price thereafter, right? Because the share price growth is way ahead of the profit growth. Now you can take 2 points of view. You'll say that look, it's gone up. Yes, it'll go down, but I'll just keep the position size unchanged and deal with the correction when it comes, right? But given the nature of our job, right, when much of the money comes on the run up, right, when the portfolio run ups, that's when the public invests. If they come in at the top and you keep them as the drawdown happens, it's obviously very painful for them, right? We hadn't managed large scale money in that sort of bull market before, and we had sort of not realized the consequences of staying invested. Let's take an example, Divi's Lab, for obvious reasons, because Divi's got that Molnupiravir contract from Feb 20 through to the end of COVID, assume Diwali 21, Divi's had a roaring run, right? They made extra profits courtesy Molnupiravir, but the share price rose way above that. So when we saw broadly that COVID is ending, we pulled back the Divi's position, but I realized later on we should have pulled it back far more, because Jan 22, I remember, Jan 22 in the earnings call, Divi's said, देखो Molnupiravir done hai, COVID is finished, and the market then said, was khatam ho gaya Divi's. In 9 or 10 months, Divi's share price halved, right? And our clients bore the consequences. So we sat through 22, 23 saying it's not fair on the people who came in at the top, right? So either we stop taking money when the portfolio is doing really well, we stop taking money. If you're not going to stop taking money when the portfolio is doing really well, then you adjust the portfolio so that those who come in at the top don't have to face the drawdown, right? So that was the first big learning. Second question was, well, if you want to adjust the portfolio, how do we do it in a methodical way, right? Bolna to easy hai ki hum karenge, but how do you do it in a methodical way? And therefore, there the global compounders team who joined us in the middle of 22, they said, look, simple thing to do here is, rather than position sizing basis earnings growth over the next 5 years, which is what we used to do, they said position size basis आपका rate of return कितना आएगा. So earnings growth, assume it's 20. If you believe the PE multiple will halve, taking an example, the PE multiple will halve over the next 5 years, then subtract 8% from the earnings growth, 20 minus 8, आपका 12% return आएगा, factoring in the correction in the valuation over a 5-year cycle, right? So position size basis the fact that the stock will not make you the earnings growth of 20, but more like a return of 12%. And therefore, you'll naturally position size down, right? And in doing so, you'll incorporate your expectation of a reversion to mean on the valuation multiple. So late 22, early 23, we started understanding this. It's middle of 23, Mahalakshmi, we implemented that, right? So the first was the realization that clients come in at the top. Therefore, they suffer when the drawdown happens. And second was the realization, to prevent this problem, to prevent the client from suffering, you move to an IRR principle. And related to that was the realization that if you want to do this, you'll need, rather than having say 60, 70 stocks under coverage, we'll have to move to 130, 140. So through 22, 23, 24, we grew the research team, increased the number of stocks under coverage. Thankfully, hundreds of IPOs started coming, so it gave us a wider world to also choose from. And having a bigger coverage set meant that if something ran up sharply, we could pull the position back and still have other choices to invest, right? So it's very difficult to learn these things from a book. You can learn from the book Valuation, but you don't learn from a book that a small firm can, in the space of 12 months, 3 years into its existence, end up pulling in 5,000 crores, right? And that 5,000 crores is coming, we're sitting at home speaking to clients, and 5,000 crores is coming, and it's a bewildering experience. It's only with the benefit of hindsight, as the dust settled in 23, that we fully appreciated what we had gone through. We're wiser for it. I wish there was a sort of YouTube video I could watch in 2018 when we started the firm.
Take one now,
Right, yeah,
which you are, of course, making now.
Right. So those who are watching, right, be careful. If you start a business and it's successful, then the biggest challenge is early success. Early success blindsides you to what might come on the back of that success, right? If you were running a coffee shop, it would be a different type of challenge. Running a portfolio management company, which takes money in on an ongoing basis, had a different sort of challenge. So we're wiser for it, and the relieving news for us and for our clients is last couple of years, as the economy has slowed down, and as we have been more disciplined using this IRR principle, right, earnings growth plus changes in valuation, performance has improved. So we launched Global Compounders roughly 3 years ago. That's compounding in rupee terms at around 26-27% net of fees. We launched Meritor Q, which is a quant portfolio based exactly on this mathematics that I described. That's compounding at 17 and a half, so 200 bips ahead of the benchmark. Little Champs and Rising Giants are small and mid-cap portfolios which got pulverized in 21, 22. Again, in the last couple of years, the tide has turned. Kings of Capital, a portfolio which does HDFC type investing. It had a really rough run through 22-23 as the PSU banks rode away. Last couple of years, Kings of Capital has come back. The consistent compounders portfolio, it's improved in the last couple of years, but we would like to see it improve a little bit more. I think we need to implement the IRR piece a little bit more proactively there.
For somebody to say, look back, reflect, and say that, you can get blindsided by,
through 20. And again, the nature of the job is the more successful you are, the more people will put their faith in you. And the better the fund performance, the more they will put their faith in you, right? And that's the juncture, now that I've been through the cycle, that's the juncture we need to be most careful about taking money and deciding what to do with it. You have a choice. You can say, I'm not going to take your money now that the fund performance is really good. Or you turn around and say, I will take your money, but I will cut down the position sizes of the stocks which have made me the most amount of money in the last couple of years. And in reflection, we should have done the latter. We didn't. We're wiser for it. And now we do that more often.
Right. So, but is this about position sizing alone? Because position sizing definitely, from a portfolio perspective, you have to keep looking at every position and calibrate in the manner you've said. But a larger lesson in terms of thinking about valuations, because, one of your beliefs was that, we can disregard PE as long as the company's moat you believe in.
Point. And so if it's an individual who's watching this, right? Yeah. And an individual is running his portfolio and he doesn't have to worry about the third party money coming in, then I would strongly suspect do what the coffee can investing book tells you. Let it run, because you as an individual, it's hard for you to time the market. It's hard for any of us to time the market, right? And therefore, as an individual, let's take an example. Let's take Divi's. It's the perfect example. Divi's was a successful company till the beginning of COVID, right? It was a 30% ROCE, 18-19% EPS growth company, very successful company by every definition till COVID came. COVID supercharged their share price, and we made a ton of money on it through 2020, 21. Jan 22, COVID ends. Jan 22 to roughly Jan 23, Divi's halves. Now, if you as a investor running your own portfolio got rid of Divi's, right, then the post Jan 20, I think Feb 23, Divi starts rallying again. Last 2.5 years, it's had a spectacular run again, right? I think it's doubled again if my memory serves me right. So if you get rid of Divi's saying COVID khatam ho gaya, Divi's is expensive, let me sell it, then for no good reason you've let go of a very successful company, right? So it took 4 or 5 of us to say, let's reduce the Divi's position. I wish we'd done a little bit more of that in Jan 22. But anyway, we reduced the position. And it took enormous clarity of thought on the team's part to say late 22, early 23, that Divi's is now going to have a stellar run. Let's jack the position size up, right? And we took it, I think, all the way to 8-9% of the portfolio, and made the most of the fact that that post-COVID, Divi's has, and a lot of credit to Kiran Divi and the team, has become an even stronger firm. So as an investor sitting at home, it's highly unlikely you'll get out, right? You'll get those calls, right? So stay invested in Divi's. Yes, there will be points in time where Divi's will become a larger part of your portfolio rather than a smaller part. And there will be points in time when Divi's will give you euphoria, and other points when it will give you pain.
Valuation, does it mean anything to you?
We have a reasonably clear view what sort of EPS growth we'll get, earnings growth we'll get over the next 5 years. And then if the stock has done really well over the last couple of years, we then say, yaar, ab to mean reversion aayega, as you're rightly picking up. How do you figure out what's the extent of mean reversion? So 3 simple things that we do, and I'm not claiming that any of these is perfect. The first thing we'll do is we'll say, if the index, say the Indian index in the long run trades at 15-17 times and said stock is at 120 times, then that's a sign that there's plenty of pullback that could happen. So that's the first reference point. Index kitne bit trade karta hai long run mein, right? Now the Indian index historically been 17, now Nifty is 21, 22, so maybe you have a little bit of re-room, but if something's at 120, it's clearly a million miles away from 21, 22 as well. The second is, what does the sector trade at, right? So let's take retail. If retail trades at 40, 50 and Trent is at 120, that also suggests that Trent could pull back, right? And the third is, what has the said company traded at historically? So Trent, I think historically has been around 50s ke aaspas, 50s, 60s ke aaspas. And if it's at 120, you've got the third benchmark there, right? So you take all 3 data points, index, the sector historically, and the said company, and on that you sort of reach a broad understanding of that, say 60-70 could be fair value on Trent, which is roughly what our thinking is. So if Trent is at 120 and 60-70 is where fair value would be, and you say there could be a 5-year adjustment for the PE house, so you then say minus 8%. I'll take the earnings growth, 25 ka I think earnings growth ka projection tha, maybe a little bit more, shave off 8%, and that gives you to 17-18%. That's my position sizing metric on Trent, right? That's what we do. What are the limitations of this? Let's take Indian retail. Let's take Titan. Titan, if you see over the last 20 years, the steady state PE has constantly gravitated up, right? And it is gold finance, usme high tech kya hai, right? And that would be the common point of view, that this is gold finance. I don't know what's the disruption in gold finance. It's been happening in India for millennia, and yet Titan has consistently re-rated up. And they've done supply chain improvements, they've put working capital improvements, they have acquired other businesses, the Carrot Lane acquisition, which has been very successful. So if you keep doing this on Titan, you have to constantly readjust the steady state PE to adjust for the fact that the Titan of today is actually a very different and arguably better business than the Titan of 10 years ago. This piece is hard, right? So easy part is aap 3 comparisons kar lo, benchmark, Nifty, sector, company itself. But the hard part is to step back and say, is the company today same as the company a decade ago? Is it meaningfully better? If it's better, how do I readjust my expectations of the steady state PE to incorporate the betterness?
Is there any method to do that? What is your secret sauce to assessing that?
So working on it, but for those who want to have a crack at it sitting at home, return on capital, if the rolling 5-year ROCs keep drifting up, so just take 5-year ROCs, if the ROCs are drifting up, there must be something that the company is doing right.
And how about the reverse? For example, now we could probably delve into Asian Paints, which has been one of your favorite companies again for a long time, but you've also cut position there. The moat has got significantly disrupted, something one could not have imagined, because for years and years, right from the time, I think in your first book also, you wrote about the moat. Nobody believed that Asian Paints moat could be disrupted at all. And look how it has got disrupted.
Asian Paints is roughly 150,000 retailers to whom they sell. They're able to deliver to them anywhere between 2 to 4 times a day, and thus they give dealers inventory turns that no other paint manufacturer is able to give. And even if a rival paint manufacturer is giving 3x the dealer margin of Asian Paints, typically the Asian Paints dealer will still make more money because the Asian Paints inventory rotates 3 to 4 times faster, sometimes 5 to 6 times faster than the rivals ka dealer margin, right? That's the moat, right? And it's very difficult to create the supply chain logistics. It's decades of investment, not just in trucks and depots and so on, but also decades of investing in what is now called big data and AI, right? They started doing it 50 years ago, but now it's called big data and AI. Very difficult for a rival to figure out that तारदियों में दिवाली से 2 दिन पहले दोपहर को 3 बजे what 5,000 shades of paint will sell, right? And that proprietary data and the proprietary logistical capability is the moat. We haven't seen anything which suggests that the new players can challenge that. What the new players are doing, and if I was them, I probably would do this as well. And what the new players have done even 20 saal pehle is that taking, say, 10,000 crores, that's the money they're saying we can burn. They're going to the dealer and saying, आप Asian Paints के छोटे dealer हो, right? Why don't you become our dealer exclusively? Right. We will give you way more distributor margin than they do. We appreciate the fact that our paint will sell far less because our turns are less, but we'll compensate for that by giving you way more 3x 4x dealer margin. So अगर वो लोग 3 रुपए देते हैं, हम आपको 12 रुपए देंगे, and we'll compensate therefore for the slower turns. And you should consider us, and we'll also pay for the fit out of your store. Aapka store nice dikhega. And in doing so, the newcomers are burning through 5,000 crores, 10,000 crores a year, right? They are entitled to do so. It's their money. But we're not so sure how sustainable this will be. Because presumably at some stage, whoever is building out a paint business in India will want to show a profit. The market share losses are not enormous here. They've lost 3-4% market share. In the context of a business with 53-54%, 3-4% is not enough to make me feel that कोई profound moat पे attack आया है, right? So this is not a conventional retail moat. This is a very unusual moat, and actually similar to the moat that Zudio, I think, is building out very capably in apparel retailing. The deeper issue here is during COVID, or in the aftermath of COVID, in that revenge spending boom, I think households over-invested in ghar ka doing up. Everybody was very excited because they'd been sitting at home for 2 years. Yeah. They had money at hand, so everybody went on a massive spending spree कि घर को अच्छा बनाना है. Right, I remember through 22, 23, every Saturday, Sunday was difficult being at home because all around my building, people were doing their houses up. खिड़की से देखता था, सामने वाले building में also people were doing their houses up. I think that piece has stagnated, partly because people overdid it, partly because of the job situation. Right. And you can see that in lots of things. आप देखिए कि paint का volume growth at the industry level is barely 1 or 2%, right? And if volume growth is conked off, that in turn means Asian Paints ka overall PAT growth stagnates. The comparative piece, I think, is a secondary challenge here. The more primary concern is when will the home decoration cycle revive in India, right? And on that, we go back to the beginning of our discussion: GST cuts, tax cuts, interest rate cuts, and hopefully, a year out, we'll see the beginnings of a revival in home building.
The value of a moat from an investing perspective is to be captured in the number that ROCE captures, right? So, to the extent that a new competitor is coming and taking away market share from you, it is going to dent you financially.
Right, so all you have to look at is the competitor's strategy sustainable? Can the competitor burn through 5,000 crores of capital every year for 10 years? Because that's what you need to do if you really want to take on Asian Paints on a sustainable basis. Remember, Asian Paints is making money hand over fist, right? This is a 30% ROCE business. Even if it becomes a 20% ROCE business, they'll be making massive amounts of cash. So can you really take on Asian Paints over 10 years and burn through 20-30,000 crores of cash? आपके पास उतना पैसा है क्या 20-30,000 crores जलाने का, right? And therefore, if the competitor simply is making a short-term foray, creating a lot of awaaz, a lot of media publicity, discounting, lot of media publicity and giving generous margins to the dealer, so you as an incumbent should say, let me step back, drop my operating margin for a couple of years, be nicer to the dealer for a couple of years, and make it harder जो scorched earth strategy बोलते हैं, make it harder for the incumbent, because I don't have any problem with cash. I've got deep reserves. So I'll just step back on my margin, let the dealer make a little bit more money, and make it very difficult for the opposition to build a profitable business, right? It's been done in many industries in India, and I doubt paint will be an exception, right? So Asian Paints, as I said, has I think 3-4% market share loss हुआ है. But the bigger issue hitting the numbers is the cyclical downturn. I don't think the new entrants are that big an issue. After all, remember, one of the entrants went off and bought a conventional paint manufacturer. If the new entrants were so capable of challenging the incumbents, why would they spend billions of dollars buying a conventional paint manufacturer?
True enough, but one point, if I were the devil's advocate here, Asian Paints ROC may be more than upwards of 35%. I don't know what it is exactly for last year, but definitely significantly higher. So a new entrant who is coming in, for them, the benchmark is not 35%. You don't need to make a ROC of 35%. You are happy to do 15%
if they can make money, it will be a triumph for them. But they're a million miles from making money.
So isn't there enough headroom? You have a 20-30% return.
Make money in paint, no? Which is why it's a consolidated industry. Right? There's nothing rockets. There's no rocket science in paint. It's a.
No, I'm saying the return threshold for the new entrant is significantly lower.
I think breaking even will be a task. I agree with you. Return threshold will be lower. I agree. Right? Maniye 15%. But just generating.
To sort of do this for a few years.
How will you make money? I mean, how if you're giving the.
Why do you say that?
So here, I'll do the maths again, right? If you give the dealer 12 rupees, 15 rupees a litre, right? In order to make it remunerative for him to hold your paint, remember your inventory is slower moving. Your inventory is slower moving. You're giving the dealer a bigger margin, so the dealer is incented to hold your paint. Now, back in the ranch, you now have to, with far smaller scale than Asian Paints, your scale is 1/20th of Asian Paints. At far smaller scale, having given the dealer away 4x the margin, you now have to turn a profit on an industry where you've put up 5 factories. So if you do the math on that, it's highly unlikely you'll be able to turn a profit in the next 2 to 3 years. In those 2 to 3 years, if you burn through anywhere between 20 to 30,000 crores, if you have the money, as I said, well, good for you, you have the money to last the 2 to 3 years. But my reasoning is at some stage, as people have found before, Sherwin-Williams, remember, entered in 2006, burned through $1 billion plus in 4 years and left in 2010. I think they sold to Berger Paints. When they sold Mahalakshmi, they were not making any money. Forget making money, they're barely making any revenue. Right, so I suspect here we'll see a repeat of that. Now, where I think the entrant has got very unlucky is they have entered at the point in the cycle where the cycle is tanked. The cycle has tanked, it's hit Asian Paints, but at least Asian Paints is a going concern with 50% plus market share. They'll still make a very healthy profit, albeit not what they would have liked to. But for the incumbent, this is a real challenge, right? आप घुसे sector में story खत्म होगी. It's like setting up a asset management company. And bear market शुरू हो गया, right? It doesn't matter how much money you have. If you set up an asset management company and bear market शुरू हो गया, your first 4-5 years is a wipe out for you, and therefore for you to make a IRR or a decent return on the business becomes very hard. That's roughly what's happened to the entrants into the paint industry. They got very excited looking at Asian Paints ka PE multiple, right? Probably reading Unusual Billionaires and watching our videos. They got very excited. Poor fellows dumped in billions of dollars. And just as they entered, party khatam ho gayi. And they must be cursing themselves, saying, "Kya kar diya humne?" Right now, we are cursing ourselves, saying, "Why did we have such a big position?" They are cursing themselves.
Why did you go out and talk about it so much on video? So is that a lesson?
So that we are happy about that. If people watch the video so much that the smartest people in the land with the deepest pockets commit billions of dollars basis our books and videos, then it is what it is. But I think they must be really cursing themselves, because we haven't lived through an economic situation in India where paint volumes are growing at 1 or 2%, right? It's unbelievable, right? I don't think it's happened in the last 20, 30 years. And let's hope for everybody's sake, including ours and the new entrances, that we do see some revival in paint demand, because it suggests a macro which is hostile to to basic consumption. And that's where, again, I think kudos to the PM for the 15th August GST announcements. Hopefully they'll come through nice and fast.
Fair enough. Now, give me 3 examples of stocks which have taught you the maximum.
Does the maximum?
Taught you. It could be positive mistakes.
These I explained at length, right? It was great lesson. Same company, up, down, up again. Right. And thankfully, we, at least on the last 2 years up leg, we've got the best part of the upside. I think HDFC Bank, big learning, right? That Ferrari versus 1 liter ka engine, right? I in my investing career, if somebody had told me when we set the firm up in 2018, Mahalakshmi, that you'll have a portfolio of HDFC Bank, Divi's Lab, Dr. Lal Path Labs, Asian Paints, these sorts of quality franchises, and still in 15 months the portfolio will fall 15%, even though earnings growth is double digits, I would have said nahi ho sakta, right? But we lived right. So we lived through it, and we learned the lesson. You could have a top class portfolio with earnings growth.
Right.
Back in 22, there wasn't an earnings growth challenge with almost any of the portfolio. In fact, earnings growth was, I think, mid-teens se bhi zyada tha earnings growth. And we used to sit in the office thinking, earnings growth to badhiya hai. Yeah. Why is the portfolio going backwards? So that was a big lesson, that if you go through a period where you're compounding, I think the 5 years ending calendar year 21, our portfolio compounded at 25%. Market had done 18. Our portfolio earnings growth was 17, 18. And therefore, we had done way better than we should have. Life has now taught us that you now need to expect a reversion to mean and adjust and factor that in. So that was the second big learning. And the third learning was actually if you ask me, the hardest learning of them all, right, was Relaxo. Relaxo was different in the sense that obviously during COVID, people sat at home, bought chappal, and we over-earned. Relaxo over-earned, we over-earned during COVID. Relaxo, chappal is an essential product. Okay? So we thought that there will be a base level of demand that will sustain after COVID. But in Relaxo's case, the company itself, I think, suffered in a way we didn't expect it to see it suffer, right? So most importantly, after COVID, when oil prices started rising, they hiked their prices, right? It took us 3-4 months to realize that the price hike had been pushed through, and we saw it on Amazon, that their chappals were now significantly more expensive than they were during COVID. During COVID, I remember it was selling at, the entry-level chappal was at 85, and then a year after COVID, the entry-level chappal was 150, 160. And as soon as that happened, they effectively lost their leadership to the informal sector. The informal sector makes chappals by melting doodh ka packet. Right. Right. So obviously those chappals are 50-60 rupees. So if the quality, the organized player is at 80 and the doodh ka packet ka chappal is 60, well, the public said we'll buy the 80 rupees ka entry level chappal, right? But if the organized player is at 150, right, and 60 for the informal sector product, then the market shifts, right? And that piece was a big learning, that you could have a company which has historically made very good decisions, very good corporate decisions, enriched shareholders to the tune of 100x, I think, in the preceding 20 years, and then make strategic misjudgments which cost them and cost us. And remarkably, to this day, right, we're sitting now in 24 and it's been 2.5 years since we sold Relaxo. They still haven't quite got their mojo together. And yet it is footwear. There's not been a massive structural change in the footwear market. And yet the fact that a franchise which was doing ever so well for 10-15 years starts then regressing, that was another big learning. And in a way, perhaps the most painful of the learnings.
Anything else which taught you a specific investment lesson?
I think in small caps, in small caps, we made a lot of money on specialty chemicals through COVID. So 2019, 2020, 2021, right? Our Little Champs portfolio doubled in 3 years on the back of a big focus on both specialty chemicals and the ancillaries related to it. Then COVID ended. Chinese supply came on stream, China started dumping in the world, and we suffered badly on those same spec chem investments, which had done well for us. And that's when we realized that when the world is jammed, when global trade is frozen, certain companies look to be structural compounders because of specific circumstances with global trade being frozen. You allow global trade again, and the same company now looks to be in brutal competition with Chinese people and looks like a cyclical company. And hence you have to be realistic in you have to take a much longer view in how you assess companies rather than doing it on the basis of, say, 3 years of data, which is the mistake we had made. So Little Champs therefore suffered on the account of the spec chem investments not working out at all in the post-COVID era.
Would you also take this learning to earlier point you made on, you said as a private investor, if you found a great company, sit it out. You don't think about regression to mean and so on. So for commodity companies or cyclical plays, would you relax that rule? You'll say you have to play by the rules of cyclicality.
Bigger point here, what I realized after living through this is everything actually is cyclical. So even Hawaii chappals are cyclical, paint is cyclical, right? Correct. I hadn't realized paint is cyclical. Path Labs ka blood test is also cyclical, right? Or we saw Dr. Lars rally again. So the remarkable realization, right, and this was 23 when it hit us, is everything is cyclical. You as the investor have to be able to see the cycle, right? It's not going to be blazingly apparent in the data sometimes. If it's steel, it's very easy to see. If it's real estate, it's very easy to see. But even in paint, even in diagnostic tests, even in chappal, there's a cycle. And one of the things as an investor you try to train yourself to do now, and we now try to do this consciously, is to understand the cycle where others believe none exists.
So you will trade according to the cycle.
You're to understand the cycle. Remember, we're very rarely buying stuff and completely dumping it. But let's take an example. If, as we were discussing today, right, we're in a difficult juncture in the banking cycle. NPAs are coming through and liabilities are being very hard to raise. So this is a great environment for an HDFC bank, and I suspect it'll stay great for a few quarters yet. But when the going for HDFC Bank becomes really good, and they get with their hammer lock on high quality liability or low cost liabilities, they're able to make ROEs move towards the 20% number again, right? It'll be the 15 year, but at some stage they'll start moving into the high teens again. That's when we have to say that, look, HDFC Bank is enjoying this big advantage of others because liabilities are so hard to source. When the stock market pulls back and liabilities, people go back to savings deposits, other lenders will also get easier access to liabilities, and the competitive intensity for HDFC Bank will go up. Right? That piece, this second, third step piece, was not as well developed for us when we lived through COVID.
Last questions. One is that, like you said, last 2 years have been sort of difficult for you. Your
for us. 2023 were horrific for us.
Right. But in terms of business, your AUM was, I think, in 2022 about 14,000, 15,000 crores.
Definitely, we didn't go that far.
12,000.
We got to top of the cycle with our own AUM. We got to 10,000 crores, and that 10,000 crores has become 5,000 crores now. Usme se, some of it was that 22-23 ka eye-watering 15% drawdown, right, where the AUM itself fell because the product corrected, and the rest of it, around 4,000 crores, have been redemptions through 23, 24, and early 25.
Lessons you've taken away, because this is a cycle that every investor goes through at some point in time or the other in your career.
Look, I mean, again, you read about it. Before you set up a business like this, you read about others going through, right? And you read plenty of fund managers have said, if you can't live through a 50% drawdown in a stock, then you don't deserve to be an investor. Padhte to aap ho. But then when you live through it, you realize that part of it is you're holding your own mind and body together as the whole world comes at you and says, look what a loser you are. In 2021, you shouldn't have done that. I think there's a fair bit of signal in that, right? And we need to understand that and say, okay, theek hai, we held expensive stocks. We obviously shouldn't have. What is the way we reduce the chance of that happening again next time round, right? And we've tried our best in the last 3 years to take the learnings, ignore the noise, and carry on managing money.
Are there any investors in India that you truly admire and have learnt from?
We've known Pulak Prasad for a long time. In my brokerage avatar, I knew him as a guy who would suggest stocks and help Nalanda do block deals. But as we've grown older, as we lived through the cycle ourselves, right, our admiration from the team at Nalanda has grown. And his book, I think 2 or 3 years ago, he published this lovely book on what evolution teaches us about investing. I thought that was epic, right? I think everybody in the office read it thrice over. It became like a Bible. I think another investor I've looked at from a distance and admired enormously, learnt a little bit from is Shankaran Naren. So I wrote about him in Gurus of Chaos 14, 15 years ago, feels like a lifetime ago. I wrote about him, and then both as a broker, and then subsequently we did a little bit of work with iProve. We got to learn from Naren. Watching him go through these learning cycles, right, and he's done it for 30 years, has been very rewarding. And if I look back at the last 4-5 years, through COVID, he and I would talk on the phone, and he would tell me, be careful about valuations. Look back at periods of time where expensive stocks corrected, and I kept telling him that this is so unusual, COVID to unusual hai, so how can I do historical analysis? And in the final analysis, Naren was right. But we live and learn. And in small cap investing especially, a lot of what he's taught us, we've tried to incorporate that in how we invest in small and mid caps.
Sure. Wonderful talking to you as usual, Saurabh. Thank you so much for your time and, of course, your investment experiences and insight. Thank you.